Hey, hello everybody. It's the weekly Q&A, the most alpha show anywhere, all the time. We're going to do a lot of expected value analysis, how I think, how I approach investments. We'll talk about Solana, CleanSpark, top altcoins, talk about Bitcoin's future, miners. We're going to compare Zeus and Wormhole. We're going to, what else? How to choose leap options, how to take profits, and so much more. Talk about the mess that's in macro right now as well. So thank you all for coming. We'll try to get through this in about 40 minutes. May take a bit longer. And for those that are coming later, everything will be perfectly timestamped to the second. Thanks to the brilliant team behind me. Thank you, Glenn, Joe. Thank you to Sean and TND Tesla and K8 and the mods in the chat. Let's go. And none of this is investment advice. I'm just a guy on the internet sharing what I do. That's it. And the questions all come from Patreon. And every week, the temperature is different. The interests, the concerns, the worries are different. This week was super fascinating. A very, very wide breadth of questions. So this one is kind of fascinating from, from the psychological point of view. At this point of time, when you see, i.e., sudden drops in the market, do you ever have any doubts? Do you personally ever think it's possible for Bitcoin that it could just collapse? And the whole idea of cryptocurrency, do you ever lose faith? Well, this is so important because with any investment, I always say investing is a blood sport. You always have to make assumptions. So this is how I approach crypto. So first of all, I'm always prepared for Bitcoin to go to zero. And that's one of the reasons I invested heavily in proxy assets like MicroStrategy. It's far bigger than my Bitcoin position. But because I used options to generate a huge amount of leverage with very little capital down. So if MicroStrategy blew up and went to zero, Bitcoin blew up and went to zero, I'd lose my Bitcoin investment, but my MicroStrategy investment is negligible. And that's kind of how I play the game, which is super fascinating. And that's one of the things that has been life-changing for me. But always, when I look at things, I look at an EV analysis, not an electric vehicle. They show an expected value analysis. And I only allocate about 1% chance. Actually, right now it's probably less than half of 1% chance that Bitcoin will ever go to zero. So let's look at exactly what that is. So EV is a whole bunch of probabilities times outcomes. It's the easiest thing in the world to do. And I suggest everybody do it. And also, this takes care of the risk element. So if you have an asset and you believe it's going to go to X, but there's a certain percentage chance it's going to go to zero, that is how you position yourself on the whole risk continuum, which I also do with many of the investments I make. Some things may have higher return, but they also have a higher probability of going to zero or losing you money. You don't like that. So let's talk about Bitcoin, a simple EV analysis of how I've always approached it. So imagine there's a 1% chance. That's your probabilities on the left. 1% chance it goes to zero. Okay? There's a 50% chance it goes to $500,000. And these are example numbers. They're ballpark kind of my targets. But this is also by the year 2030. Not today, not next year, the year 2030. And a 49% chance it'll go to $1 million. Okay? No, 50% chance it'll go to $1 million. 49% chance it'll go to 600,000. I got that a little bit backwards. So when you add up the probabilities of all of these, your expected value outcome is $794,000 by the year 2030, 2032, give or take, add 2 years for extra margin. And that is a monstrous return on investment of over 1,200% in just 6 years. That's the way I approach investing. Now let's give you another example. Solana, when it fell to $8, why did I put so many cards on the table? Because I did an EV analysis. 10% chance when it was at $8 that it would go to zero. But back then, I assigned a 90% chance it'll go to $150, which is basically half of the previous bull market all-time high. So therefore, my $8 investment was probably going to yield $135 in 18 months. And that's 1,687%. So you can see the method to the madness here. Everybody do this for every investment you make. And it'll make you much more comfortable and it'll help you allocate capital better. Okay? And give you much more confidence in how much to push onto the table, as they say. Hope that answers your question. So yeah, can Bitcoin go to zero? Yes. Do I get worried about market fluctuations? No, because I study history. Drawdowns are interesting. And we have a wild card this time around in this bull market, and that is the ETFs, which are fascinating to watch. That's why I study them very carefully too. Next is from Todd, PA. I enjoyed Plan B's latest video, but not understanding how he says Bitcoin will go up because miners need to make more money. Can you unpack that and what the nuance is I'm missing? I get that Bitcoin price needs to increase for miners to make more money and to stay afloat, but why does that drive Bitcoin price? And industry does not work that way. What is unique about miners' financial situation being a catalyst to drive price up? So this is super interesting. And I listened to that little piece where he said it, but he didn't divulge exactly how. But I'm going to make some assumptions here as to the impact of the miners and why I am heavily positioned not only in proxies like MicroStrategy, but also Bitcoin miners. And I spend an inordinate amount of time to find the winner, like everything else that we do here. So let's talk about the impact of the halving on miners. And I'm not putting words in Plan B's mouth, but I am maybe trying to back into or unpack what he's thinking, because this is how I view the world. Now, the Bitcoin halving events reduce the block reward for miners by half. That creates a supply shock that can potentially drive up the price of Bitcoin. And that is assuming the laws of supply and demand work, and I do believe they do. Now, miner profitability also depends on the cost of mining and the price of Bitcoin. Low prices may lead to decreased mining activity, necessitating a price increase to maintain network security. Okay, so a couple of little twists here. However, as the supply of Bitcoin decreases due to the halving, and of course, this drives up the actual price, and this in turn drives up mining activity. The more miners will plug in their rigs when there's more reward, i.e. the higher the price of Bitcoin. But there's a few more twists as well. During these bull runs, miners are incentivized to hold on to their Bitcoin rewards because they know the market very well and they anticipate future price increases, which is like an additional supply shock. So not only do you have the miner reward cut in half, but then you got the miners knowing where the price is going to go in the year and a half following the halving, so they try hodl as much as they can, or just find creative ways to pay their bills, but keep as much of the Bitcoin they have, which is an additional supply shock to the system, which in turn also drives the price of Bitcoin up. And that's it. Now, the financial situation, however, of miners and the market sentiment is very interesting. There can be struggling miners that need to be acquired or turn off their rigs or whatever will happen. But either way, the clever miners that spent the bear market issuing shares, raising capital, selling their Bitcoin to buy the latest and greatest, most effective and efficient rigs will do the best. And that's what we look for. And they will also, when you look at all the best miners, many of them, not all of them actually, there's a couple of exceptions, they all have big hodl bags and they are hodling as much as they can. They're trying not to sell this year. Selling Bitcoin at 15,000 when it goes to 60,000 a few months later is not a good idea. And they know this better than anybody. So I think that paints a picture as to how the price has to double for the miners. Maybe what Plan B said, but these are the reasons why I think it will. Not just the supply shock of the halving, but the supply shock of the miners hodling as well. Hope that helps. Next question is from T5675. I'm new to options and found several CleanSpark options with a break-even value below 19, expiring July 2025. Is it a no-brainer to get the options instead of hold the stock? And if the January and July calls cost the same, which is better? Okay, this is going to be a tricky one, but it's so important to get right. And I'm going to share a model that nobody's ever seen for the first time, and I'll post this model on Patreon as well later today. So you can all create your own version and play with it and plug in your own numbers for any options you like. First of all, as well, I am a heavy duty options trader. It's basically all I do and all I've done for a very long time. And I have a large position in CleanSpark. Much of it actually has zero cost basis because I got into sold puts to buy calls, and then I sold calls out of the money to reduce my cost basis. So it's magnificent to be in options if you know how to buy the right one. So I'm going to explain exactly my process and how I do it. And bear with me, this will be a little bit tricky, but if you want to get ahead in investing, and if you're new to options, only paper trade them first because they're very risky, and only buy long-term options. Don't buy short-term ones. They're very risky too. So these are the CleanSpark July 2025 call options. You've got the last price. You've got the date, of course, July 18th is when they expire. So that is let's call it a year and a half away nearly. You got your bid and your ask. Some of these as well. Look at the spreads between the bid and the ask. 1150 bid, 1640 ask. You don't want to pay that money. And what I also do is I spend an inordinate amount of time analyzing these, and I've been doing it so long, I can look at 400 numbers on a page, and I can tell you which ones are priced wrong. They're the ones I buy. I sell the ones that are too expensive, and I buy the ones that are too cheap. And you'll see a lot of those examples here on this. Then you look at the volume. So there was a time with CleanSpark a year and a half ago, and I was buying hard. I was all the volume. There was no depth. There was no liquidity. The entire open interest was me. Like just me. Nobody was touching these things. And it was extremely difficult to get fills, but I managed to get them all as well. And then on the right, you have the strike price. So make sure there's volume, especially if you're using large amounts of money, and make sure there's open interest so you can actually sell them back into a market. Basically, that reflects the liquidity. Now, what we're going to do is break them down. And I'm going to start with simple examples and then walk through the model, how that works, and layers too. So if you have an option with a strike price of $3, ask price is $16.40. If you imagine CleanSpark is going to $50, $50 minus 3 is 47. That's how much this thing is worth when you sell it. If we get to $50, and the cost of the option, the profit is 47 minus 6 for 1640 is $30, and your ROI is $160, 186% for buying the $3 call. Of course, it makes no sense to buy something so deep in the money. Second option will go to $5 strike, same thing, 246% ROI if we get to $50. That's better. Third one, this is the strike price is $7. The call option is $12, and the ROI is 252. 252 versus 246. So you see, the higher we're going in strike price, the more return we get on our investment, and that's very important to look at too. Now, before I show you the rest of all the call options, because I model them all out, I'm going to show you the most important thing, and that is why we built this. This is the layer in, layer out model to help get in and help take profits as well. Taking profits is the single most important thing in investing, and we all need to get better at it. So this is the LILO model for CleanSpark, and you can see layer 10 is about $50. That's why it's kind of my target, my bull target for this market run. 41 is layer 9, 33, layer 8, 22 is layer 7. We've already been above 22, and you see the way it kind of hits it and its resistance, and it comes back down, and it falls down to layer 6, which is 1547, and that's basically where the price is right now. So you can also play these layers. This is like a range. If you take that middle piece, you can sell calls at tops and then buy more at the bottoms when it hits that support, and just play the range and do it all day long until there is a breakout. When there's a breakout, do not be short your call option out of the money. That's when you cover fast. You got to fail fast in this market as well, because this thing can go bonkers real fast. Now, taking that information, okay, we've got the layer model, and I did say this would be a complex one, but it's so important to get it right. We got a target of, you either choose the $40, which is layer 9, or the $50, which is layer 10. Pick one. So if the price target for July 2025, which is basically nearly a year and a half into the bull market. That's a good time to get out. Now, modeling all of this as well, you can see here you have all the options that I took from that sheet, the volume, bid ask. I ignored the bid because the bids are ridiculous. Always focus on the ask and try buy under the ask. All right. You'll see as well the $5 strike and the $7 strike at the same price. That's an options pricing market inefficiency. That's where you take advantage of that. Then you got your strike and your price target of 40, and all those percentages there are the return on investment that you make. You will notice as well a lot of confluence between buying the $5 strike, $7 strike, $10 strike, $12 strike, $15 strike, $17 strike. They all have pretty much the same ROI, but try to optimize it by picking the most winning one, and that would be something like the $10 strike. But then, if you're spending $10 for a call option, and the price of the stock is $15, you are better off buying the equity on margin. Okay, you borrow, you put 50% down of your cash, get the rest on margin. That's where you use margin. That's where these options are too expensive. But it gets more interesting when you look. And this is why as well, things like options on MicroStrategy and CleanSpark, they are so volatile. And that drives the expense of these things. They just are really out of reach. However, if the price does go to $40, you can still make 3x your money, which is not bad. So you lay out 10, you get 40. Pretty simple. Now, what happens if the price goes to $50? This is the interesting part. Again, all the analysis is done for you in this model. Your ask price, your strike, and your return on investment here. This now suggests the July 18, 2025 call option with a $15 strike is the one worth buying. It'll cost you $9. And $9 is kind of closer to where we are. But again, you're nearly better off buying the stock on margin and then layering out. Or when you buy the stock on margin too, you can sell calls. So here, it's a tough one. If you did dabble, you can look at this option here. Even the $20 strike, that's out of the money. I never ever recommend buying call options out of the money, but if we do hit $50, this is the rare instance that it would actually work, and that would ROI you about 375%, which is very similar to the $17 call option, 383, which is the same as 15, 384%. As you can see here, it's not trivial, but that's how you do it. So to recap, calculate just like the EV analysis at the beginning. You calculate the ROI analysis based on your price targets. And then you lay your bets. And then you compare if it's better to buy it on margin or to buy the leap. And always buy long term. The other question was if you could buy July or January. If the same price is the same, you get as much time as you can. The more time you have, the lower risk you have as well. Hope that helps. Next question is from Ann W. If you had to pick two SOL alts, one with the best real-time solutions and one being very cheap, which two would you choose? Interesting question. And I do have an answer for that. And I also own both of these things as well. First of all, AI play. I think it has come down a lot. It's now about $3.50 as we speak. It's going back to $7 to $10, etc. And it has incredible market fit. It is in a very hot area. I've been in this for a long time at a lower price because I believe in both crypto and AI. They're my two narratives that I invest in, period. It has outperformed 97% of the top 100 crypto assets, and it's being used and utilized. Render's going to use them for compute as well. So that's my first one. My second one is Jupiter. Jupiter kind of fits your question here of the best real-time solution. I use this DEX all the time. It is incredible. Brilliant product market fit as well. Super easy to use. Lots of features. You can DCA, you can do perp trading, leverage, you can swap, and it's very cheap, fast, and very precise. You can also play limit orders too, which is one of the key things that I love to do. So there are my two, and hope that helps. Next is from Mikey Mickle the Bull. I have been watching W, which is Wormhole, and ZEUS. I did not get any airdrop. Oh, in full disclosure, I got the airdrops for both, and I was so busy I forgot to pick them up. It's just, anyways, like it's a couple of allocations of 700 tokens or whatever, and I regret that because I could have given it to somebody. But that's the problem with being busy and not being bothered by these things. So if you are planning airdrops, make sure you put a calendar reminder to go collect them because they do expire pretty fast. Anyhow, thinking of adding one of them to my SOL alt portfolio. ZEUS seems cheaper. Could you provide input on which project has more potential and which project you would buy? Let's go. First of all, quick look at the two of them. Wormhole trading at 67 cents, ZEUS at 45 cents. One has circulating supply 1.8 billion tokens, total supply 10 billion. The other one has I think 1 billion, and again about 17-18% circulating. These two are almost identical, except there's 1 0 in between the actual total issuance. Let's look at a quick comparison of the two. Wormhole 10 billion, 18% circulating. The other one is 1 billion, 170 million circulating, about 17%. A lot of the vesting here is 15 months, 24 months for the backers, the team, etc. And for Wormhole, again, 4-year vesting schedule for many of them. Now let's look at the tokenomics and the dumpage for both of these. First of all, this is ZEUS tokenomics, and you can see here the team, the foundation, the ecosystem. They are huge chunks of this, and it's going to be raining tokens for the next 30 months. All right. That's kind of the vesting schedule. So that's not good. Again, we're at like 170, 180 million now. It's just going to be liquidating forever. This is Wormhole. Exact same deal. It's as if they copied each other and create different charts and added a zero. But again, you can see here the ecosystem, the guardian nodes and strategic network participants and core contributors, etc. and treasury all have big bags and all will be dumping over time. This is the chart on ATR. You can see Wormhole actually still has a sell flag. W is the ticker. Be careful of the fake ones. And it's just been down since it launched, down 60% or more. This is ZEUS, same thing, down 60% or more. Just did flash a little buy signal here on ZEUS, but again, when you look at this and the amount of tokens that are going to hit the market, the question is, where will it go? Yes, they will pump and they will rise in the bull market, but the question is how much. So, my conclusion and why I did not choose either. Wormhole, from a user experience, has gotten a lot better over the last 2 years. ZEUS, when I tried it out, seemed 40% complete. I had very high expectations. It did not deliver on what I expected it to be able to do. And I call this dog fooding. I do not buy a crypto. And this is for anybody out there. To tell if something is good, not only do you have to look at all the data and the adoption, developers, the product market fit, but also you got to test it. See what the user experience is like. See what the product market fit is like. I will not buy anything without testing it first. I tested Parcel. It was garbage. I tested ZEUS. It was garbage. I tested Wormhole. It was okay. In fact, it was pretty good. But W, which is Wormhole, has the edge here. But as you see, the sell pressure, I wait for the airdroppers to sell out. They're not done yet. And market cap is already fair, so it's limited upside. And the constant bleed is coming. Therefore, I didn't buy either. If I had to use one, I'd use Wormhole. And I do hope ZEUS will get better because it's a super interesting plan, but the functionality is not what I expected. So hope that helps. Sorry to disappoint you as well, but I have a very, very high standard before I put my toe into any asset. Very high. It's got to be unique. It's got to have a moat. It's got to have good tokenomics. It's got to have a fair valuation. Yada, yada, yada. So much stuff. Next question. Speaking of something else, Dermo2T01 died. Hopefully I got that sort of right. Are meme coins affecting this bull run? Oh, hells yes. Yes, they are. Let's talk about the benefits first of what they are doing for the space, which is kind of cool. They are significantly influencing this current bull run, especially even before the halving and after the Bitcoin halving. And several coins like Dogecoin, Shiba Inu, Pepe, etc., all look really bullish on the charts. I mean, it's kind of insane. And there's a funny thing happening too. I think a couple of good things have happened. One is, at least this time around, people are still YOLOing into stupid things, but they're doing it less than before. And they somehow perceive meme coins to be safer than other coins. Less venture capitalists, less manipulation, less dumpage, and they're more fun to play with. So that's driving a lot of adoption into crypto, which is good. And it's interesting to see the backlash against all the scam chains that are out there, which is also good. Some have huge market caps already as well, which is bonkers. We'll talk about some of those too. And then the cons are they do suck liquidity from real chains, real good chains too. And nearly all are money grabs. So that is kind of the quick and pro and cons. Although the con list is very short, it's more important than the pros. I'm just trying to be fair and balanced as I can here. Let's look at this one. I just went to CMC this morning. Doge is now number 8, and I know Elon Musk is hinting at it's going to be used as a platform for maybe X for payments. Who knows? And then Shiba Inu could be on the verge of overtaking Cardano, which is probably fair. But again, it's just a crazy sign of the times. Now, one very important thing to look at when you look at meme coins, okay? And nobody looks at this. They just buy them because they're fun or the price goes up. You will lose. You're going to get your head handed to you. This is from our crypto compendium. This is the whale concentration of all these memes. And they all have huge whale concentrations. 99%, 99%, 95%, 91%, 89%, 87%, 86%. You know what they're going to do? All of them. I don't care what you call them or what they're named after or whatever. The people that create them will dump on you. That's why they're created, okay? If you are very clever and very good at timing and very good at TA, you can make a bit of fast money. But you make that fast money. You take your money off the table. You can let the rest ride. But whatever your initial investment is, take it off the table. Or if you make good profits, put it into a hard asset ASAP. All right? Do not be left holding the bag. I think I used that as an analogy in my yesterday's video too. So be careful of these memes. And that's the meme story. Yes, they've had a huge influence in the bull run. What I meant by sucking, so a question there, sucking liquidity from the market. If you imagine everything is a zero-sum game, there's only a finite number of dollars out there. And these puppies suck in a ton of it. It means there's no money to go anywhere else into other assets and drive them up too. So I hope that helps. Next question is from two people, from Angie and Hubin. I'm curious to hear your thoughts on Aerodrome on Base. Considering its potential impact, how do you foresee this new player affecting the trajectory of Jupiter on Solana's success? And do you believe Jupiter on Solana will maintain its momentum despite emerging competition? So you're dead right. It is a competitor potentially for Jupiter, but is it as good? Does it have as good product market fit, etc.? So yes, Aerodrome is a DEX built on Coinbase's proprietary layer 2, which is hooked into ETH. It's a central liquidity hub, and it does focus on traders and liquidity providers. Now, let's go back for a second, because there's a huge difference between something tied to ETH that's proprietary versus a layer 1 blockchain that is not. So first of all, there are challenges with layer 2s. And if you know me, I don't own any because there's certain things I don't like. First of all, they're all anchored to Ethereum. And I think Ethereum has a lot of shortcomings from a technical perspective. Also, security and trust. Base is a centralized layer 2. And it relies on a single entity for security, while layer 1s like Solana are decentralized and they have distributed security amongst many nodes. and this makes L1s less susceptible to attacks or single points of failure. Also, scalability is huge. L1s like Solana are designed to scale on their own, and Base is not in that way. It's, again, dependent to being anchored to the mothership. So the L1 can handle way more transactions like Jupiter can instead of Aerodrome. In addition, the consensus mechanism, the L1s like Solana have an innovative consensus mechanism, proof of history. L2s rely on the consensus mechanism of the mothership, Ethereum, and native token value. Obviously, Solana has its native token. Base doesn't. So skip that. And the community ecosystem, Solana has that hands down in spades, whereas there is none really, except for users on the Base system. So from that perspective, no, I don't think it'll smoke an L1. Also, if we look at the transactions, real-time TPS, 27.94 on Base right now. Look at that, time to finality, 16 minutes. Who's got 16 minutes to wait? This is what I mean being anchored to the mothership. That is a problem when it comes to markets, especially fast-moving markets. And you're using leverage. You're in a perp, and you got to wait 16 minutes to know if you got to fill. You got to know instantaneously if you're playing with money. Maybe if you're trading an NFT, you can wait, but not this. What else? Governance is off-chain, and it's layer 2. Follow Mert on Twitter to find out about what he thinks about layer 2s. So from that perspective, no, I don't think so. And I don't use the ETH ecosystem either, in full disclosure. The last time I used it was in 2021, and it was painful. And I heard it's just as painful today. It has not. The vision has not come through, and it has not solved the problems of layer 2s, even nearly 4 years later. Next question. This is from Rival Tech. Many of your assumptions about Bitcoin and high beta stock market performance over the next few years depend on increasing liquidity narrative. And what if that assumption doesn't pan out? The Fed quietly ended the BTFP program, which many analysts expected to continue, and the rate cut narrative is clearly dying, and the higher for longer reality is sinking in. Do you have an alternate forecast for Bitcoin and equity markets if liquidity dries up? First of all, it's not. And this is a few things I'm extremely confident about, and this is one of them. Let me walk you through a couple of little macro slides. First of all, the big banks. The big banks. JP Morgan, Chase, Bank of America, Citigroup, Citibank have a combined $7.427 trillion of hidden off-balance sheet financing. How is that fixed? The US cannot survive without these big money center banks. Okay? Stuff is happening behind the scenes all the time. You don't see it because it's behind the curtain, but trust me, it's happening. Like I've been talking about stealth QE happening for the last year and a half. How do you think we're adding $1 trillion every week in debt or every 100 days or whatever it is? It's because it's happening. So liquidity is being pumped into the system like literally like a World War III scenario or a C-19 scenario. It is that bad. In addition, the Fed quietly ends BTFP and boom, Republic First blows up, top 250 bank in the United States, and there will be more banks blowing up. Many of them are completely illiquid as we speak. And these guys too, these puppies, as I just mentioned, they're completely liquid. Okay, the whole system is not fungible right now. It really isn't. In addition, for the first time, I think we spoke about liquidity. You said, what happens if it doesn't happen? Well, as I shared this last week, for the first time in 65 years, the ATR model flashes a buy. And I do that as a joke, but it actually did. This is the monthly time frame, and it goes back 65 years. And M2, for the first time ever, took a dip, but then it also rose. And it's going to rise like you've never seen before. Okay? And here we go. M2 will fly. It has to, because the whole system is about to break. The only way Jerome Powell can keep the whole thing from imploding is to prime the system full of money. Janet Yellen and her treasury, the kitty is empty. They need it more than anybody else. Nobody's buying their bonds anymore. Foreign investors say, no thank you. We'll might even prefer some yen stuff instead. And that's just what's happening. It's crazy. And regarding rate cut, your other question, it's coming. Jerome Powell, his body language on the call during the week on Wednesday, when he was asked by a reporter about the job market, he already knew the Friday job numbers were terrible. And by the way, they always get revised down 80% about 90 days later, but nobody ever reports on that except for one or two people on the internet, and I'm one of them. This is the problem. Jerome Powell knows this is a problem. Janet Yellen is screaming quietly in a corner, looking for money. Rate cuts. When they happen, I'm not sure. But we now have a 40% chance of rate cut in July. And then they take a break in August. 70% chance of rate cut in September, which they have to do because the election is in November. I think it's too late to cut the rates by then. But in the meantime, the system will be pumped full of liquidity. Mark my words, it's already happening. So, next question. Oh, by the way, just to be clear, if they don't pump it full of liquidity, it will break, and that will trigger a great reset, which also has a chance of happening, and that would be a very ugly situation for everybody right now. So that's my get out of jail card free if they do decide to incinerate the system. Anyway, next go. Adrabius Maximus from the movie Gladiator, I assume. I have my Tesla bag on Robinhood. The app frequently recommends enabling stock lending to increase earnings. Do you think stock lending on Robinhood is a good idea? I would not consider Robinhood a shady company, but I do not fully understand the risks associated with stock lending. This is a very good question. And in full disclosure, I've had those offers for years and years. I've never done it. It's an easy way to get an extra 3 or 4% on your bag if you want, but there's some risks you need to be aware of. And we know the old thing. I always say never pick up pennies in front of a steamroller, that old famous finance saying. Is the risk of getting that small percentage return worth it? Okay? And I always recommend, I've got this thing called a 10% rule that I've been saying since 2021. If you do it, don't do it for more than 10%. Okay, this applies to this too. But there are a couple of risks you should know about. First of all, the use case, why do you lend out your stock? It's so people can short it. All right, so you're not doing yourself a favor necessarily, but you are helping the shorts short your asset. So that's one of the reasons why I don't do it. Also, default risk. Robinhood Securities could default on its obligations, failing to return borrowed securities. Unlikely, but theoretically possible. And we've seen worse things happen last bull market, trust me. Voting rights. You also may lose the right to vote on loan securities. So important right now, everybody. Vote. If you're a Tesla shareholder, vote. I made a Patreon post on how to do that. And follow Alexandra Mertz on Twitter. And she'll send you the link, or you'll see the link, and you can find it. She's at a wedding right now. But it's very easy to do. And vote. Do what's right. Imagine working for 7 years and then some judge in Delaware decides, you know what? That's too much money. We're not going to pay you. It's like this. If that thing stands, capital markets in the US are toast. My personal perspective. Okay, so voting rights, very important. Dividend payments, there's no dividend on Tesla, it doesn't matter. But if there is a stock that does pay you dividends, they could be at risk too. Also, market risk, there could be a fluctuation in price, and borrowers are responsible for returning securities or facing penalties. But price behavior is not guaranteed. If you don't have your stock, it's hard to get out of the position if you need to get out of a position. Also, there can be tax implications depending on where you are. Cash in lieu payments may be less tax efficient than dividends, and depending on your tax situation. So I don't know the ins and outs of that, but these are the risks. Again, interesting. Would I do it? Not personally. But if you do want to do it, don't do it for more than 10% of your bag, just in case it does blow up. Finally, best part of the week before I open up to live questions. Helping animals this week, we donated to Rick O'Barry's Dolphin Project to support Umalumba rehabilitation in Indonesia. And it's the first and only permanent dolphin rehab center in the world. And it's a release and retirement facility for formerly performing dolphins. And this is Rambo, who was in a traveling circus. Ugh. Terrible thing. And tomorrow, DCA live on my channel, but we're also going to try something new, which was suggested by the community, to stream on all channels at the same time. So hopefully we can get the technology figured out so you can watch it wherever you want. I think Mando will be streaming on X on his channel, and CTO on his. We'll give it a shot. But the community recommended it, so well, it doesn't matter to me either way. And don't forget to subscribe. Thank you so much for everybody for coming. Thank you to mods in the chat. And I'm not done yet. Some live questions coming in, probably somewhere. There they are. And thank you once again all for coming. Oh, I didn't check the Bitcoin price. Whoops. And it took a little bit of a dip. Bitcoin fell $164 since I started. Whoops. Andy, thank you so much for coming. Sorry for being late. Don't be silly. Up there in Australia, it's early morning your time, I think. Global Hawk. Thoughts on Drift token and its tokenomics. I haven't looked at Drift or Camino. I just got tired of looking at them all because they all look the same way. And I did look at it briefly, but they're all the same thing. This small allocation is just going to grow over time. Drift is a very interesting project, but these things, they're already pretty fairly valued. So I glimpsed at the market cap, glimpsed at the tokenomics, and said, I much prefer buying really good, well-adopted things that are far cheaper that nobody knows about. If you're jumping into these things late, you just could be rained on, like I showed you with Wormhole and ZEUS, and therefore I don't touch them. Charles Kincannon, do you expect Bitcoin to be range bound this summer? It depends on the money flow coming in. I'm really very happy that Hong Kong has an ETF now. Happy that other players are stacking. Happy that pension funds are coming in. Remember, this is so scarce. It only takes, it's going to sound obscene when I say this, but $30 million to buy the entire supply. Miners, as I covered earlier, are not selling. So if the people that have it stop selling, because most of the miners aren't selling, and the OTC desk gets empty again, we're going to see the price go crazy. We had our dip. More money is coming. It takes 90 days for the traditional TradFi players to get comfortable with this asset class and see what it can do. Now they've seen the bond market do terrible and bond assets, and a lot of things are risky right now in the macro. So they're going to be looking for an alternative. I expect this summer to be a little bit different. I expect good returns, and we'll probably break a new Bitcoin all-time high by July, latest August. August can be very quiet though, because a lot of people go on vacation, and September is the suckiest month for Bitcoin. Not the summer, September. But again, this time could be different. It's harder, it's scarcer, and there's more money coming in than ever before. So thank you, Piper, for coming. Adam Q, what do you think happens to crypto market if Satoshi's bag started to move? I know it's unlikely, but I've been thinking about it. Yeah, I've had this question a lot. If Satoshi starts to move or sell, it will really rattle the Bitcoin price, and we could easily get a 20% haircut. It wouldn't be the end of Bitcoin, but it could really make the price crash fast. And that's one of the concerns for, when quantum computing comes about in 2028 or so, when it's ready. It could technically crack old wallets, but I know the Bitcoin team is going to harden it and quantum proof the code, so that can't actually happen. So don't worry about that either. But again, you lose that 20% pretty much rapidly if that did happen, but I don't think it's going to happen. Shakir Hussein, funnels.com. What's your top signal? What's your views on the pi indicator? And it's showing the top is in August or in December 3rd. So we actually have an indicator called the top and bottom indicator. It includes 21 on-chain metrics, including the pi cycle top indicator. It's one of the ingredients in this big complex cake that we made. And it doesn't tell us when, but it tells us when we arrive. It doesn't project. It projects kind of how far we get there, but all the data is kind of churning live. So we don't know until we get close. And it's a heat index. Right now we are bang in the middle of the heat map for the top and bottom indicator. As soon as it starts getting dark orange, I'm going to start getting real nervous. And if you are subscribed to this channel, you will hear about it first. So that is our top signal. That was one of the first things I wanted to build during the bear, to make sure we are ready to take profits. And we're working on a new set of solutions around that too as well, which is so critical. It's not what you make, it's what you keep. Important. Doc Intern, are you still planning to do a video series for teaching teenagers and college students about finance and investment? I think it's funny because Doc Intern, great question. I had a lot of people, a lot of fathers especially, watch with their kids. Some are 3 or 4 years of age, all the way to 6, 8, 10, 14. Once they start hitting the teenage years, they tend not to sit with their parents anymore. But we have a lot of kids actually watching, and we have community members that work with their kids on stuff for the community as well. So, and everything I do is PG friendly. Some of the stuff may be a little bit complex for the kids, but when we look at things like this, we might lose a few kids along the way. But it's nothing I do. I try and distill everything down to very simple basics. So anybody who's 12 or 13 should be able to follow along with everything that I do here. But college students, we do have a surprising number of community members who are very young, like 18 to 21. I was absolutely stunned how many there were. So the key thing here is not necessarily putting together a video series. Everything I do is already perfect for that demographic, but the people themselves need to be self-starters. They need to be interested and motivated. And if they are, they'll come and this content will fit them perfectly. But if there is something that you think is very important for them, let me know. And also the Retire On series has been adopted by many parents to show how many allocations they've made for their kids. One member has 2 daughters, and this member has allocated X number of shares per daughter. One is 6, one is 10, and it projects forward the price of Tesla and how much they'll have. Also, they have some Bitcoin and other things. So that already helps too. Because if you can teach the kids early the opportunity cost of, getting a $200 designer Stussy jacket or buying 2 Solanas, there are kids there that are picking that up, and they would prefer the share of Tesla or a token or some Bitcoin instead. And when they see the actual asset grow, they really learn fast the opportunity cost. It's probably the single most important lesson to teach your kids. I'm your Huckleberry. I'm beyond blessed to be a part of this community. I'm blessed to be here with you every day too. Stephen ONPS4. With the scaling solutions of Solana, do you see the price going higher than ETH in this cycle or in the next 8 years ETF cycle? So I do believe there'll be an ETH ETF and a Solana ETF once Gary Gensler is gone. Another thing to look forward to in November, if there's a regime change. I can't remember if the head of the SEC is appointed or not. I don't know. Anyway, he'll be gone soon, and then things will be back to normal in the world. In terms of scaling solution of Solana, FireDancer is the biggest thing that will help do that. And right now we had lots of reports last week of big breakthroughs, and it's getting close. Hopefully it'll be out before the end of the year. Once that happens, there is no purpose for Ethereum. It's that simple. Maybe Ethereum will be used by BlackRock for tokenization, but it can never be a consumer chain. And to be truly successful, a chain needs to be used by literally 1 billion people. And I think FireDancer will be a big move in that direction to help that happen. When that happens, though, we're not sure. If we do get FireDancer launched at the end of this year, early next, it's just a question of building as many product market fit dApps that really, really work for users and onboard them. And we've got all the use cases, DEXs, payments, stable coins, all of that is already gravitating towards Solana as we speak. Next thing will be games. Who knows what else that'll happen out there. NFT trading, I don't know. So, Stephen, hope that helps. And thank you for your super sticker as well. Jeff Hammer, Sir Winston, Trask Bergeson, Glenn Joe, iSoddle, I like that, Sean Bosley, Crypto Katana with the big sword, Dog One, Signal 103, and Solar Bitcoin and Coffee. Thank you so much, Solar Bitcoin and Coffee, and you're a lot of fun out there on Twitter too. And AZ Ulfer, I got my eyes going. Arizona Rolfer, hope I got that right. Thank you all for coming, everybody. Hope you learned a lot. Tricky show today, but fun. And thank you for all the great questions, and thank you to the mods in the chat too. I will see you all tomorrow morning, hopefully on DCA, bright and early. Thank you. Good night.